ETFs are one of the best ways for you to invest your money and build wealth over time passively. In fact, Martin Small, who is the CFO for BlackRock, states ETFs aren't just having a moment, they're creating a movement. And since the first US listed ETF that was SPY in 1993, ETFs have continued to grow exponentially, which all it takes to master ETFs is for you to watch this video all the way through, which toward the end I'm going to be going over multiple ways on how you can build a solid yet super simple portfolio using ETFs. With that being said, let's start off by explaining what are ETFs. Now, ETFs stands for Exchange Traded Funds, which the name explains itself because exchange means you can trade these funds on a stock exchange, traded because ETFs can be bought and sold anytime throughout the day, similar to investing in a stock, and funds because this is an investment you can buy and track the performance of thousands of companies, bonds, or other securities all within one purchase. So when buying ETFs, there are two main types: actively managed or passively managed ETFs. Actively managed funds means that there is a fund manager that gets to decide what investments go inside of the fund and whether or not they want to buy or sell any sort of securities and when to do so, with the goal to try and outbeat the market. For example, a popular fund manager when it comes to ETFs is Cathie Wood. And to better explain actively managed ETFs, here's an example of Cathie Wood's, that is ticker symbol ARK, which says right away in the overview that it is an actively managed ETF and has at least 65% of its assets relevant to the fund's investment theme of disruptive innovation, which disruptive innovation is their term for how they pick their investments for the specific fund, as they believe the investments they choose could be a new product or service that potentially changes the way the world works. Something else to point out about actively managed funds is that they have a higher expense ratio, which is the cost it takes to own the fund per year. So as you can see, the ARK ETF costs you about 0.75% every year, where passively managed funds are going to be significantly cheaper for the most part. Which that leads me to now discussing passively managed ETFs, which are also known as index-based ETFs because they are funds that track particular markets. By doing this, you are getting substantial exposure to whatever markets you desire, like the S&P 500, that is the top 500 companies in the US, or a total stock market ETF that covers the majority of publicly traded stocks in the US, or even an international fund that may include significant exposure in markets around the entire world outside of the US. Which of the three, the most expensive one is the international fund at a 0.07% expense ratio, which is a big difference compared to the active one I showed you earlier at 0.75%. So now you have a basic understanding of ETFs and the difference between active and passively managed ones. I now want to explain to you the difference between ETFs and mutual funds. This is an extremely important topic to understand and can get very confusing, so I'm going to do my best to keep things simple. For starters, as I mentioned earlier, there is an ETF that tracks the S&P 500 index that is called the Vanguard S&P 500 ETF that has a ticker symbol of VOO. Now, VOO is an ETF that the company Vanguard created for investors on pretty much any platform to purchase. For example, let's say you have a Fidelity, SoFi, or M1 Finance account and you want to invest into VOO, Vanguard's S&P 500 ETF. Well, you can do it on those platforms. But if you look closely on the Vanguard's S&P 500 ETF page, right in the middle, you can see the company states that they also have an available S&P 500 mutual fund. So if you click on that link, it will take you directly to the Vanguard's S&P 500 index-based mutual fund. And as you can see, this option has 5 ticker symbols that make it VFIAX instead of 3 symbols for their ETF version. The big difference here is that you can only purchase the 5 ticker symbol fund, which is the index mutual fund. You can only get that on the Vanguard's platform. You cannot get it anywhere else. Or say that you're on Fidelity, you're going to have to pay an extremely high fee, which you should never do. And as you can see, if you try to purchase VFIAX on Fidelity's platform, you are going to be charged with a fee that's not small. Which if you wanted to have the ETF VOO on Fidelity, which is actually one of the ones that I own, you don't have to pay any fees. And something else to mention is that certain platforms like Vanguard have a required minimum investment amount that is, for their platform, $3,000, where ETFs don't have this. On top of that, if you are trying to buy or sell mutual funds, the trade is not going to go through until the end of the market day. For me as a long-term investor, I personally like having index-based mutual funds in my non-taxable accounts, and even like it better because I cannot change my positions as frequently. Whereas if you had ETFs, they trade similar to stocks, so you could buy or sell them whenever you want instantly, and that may be more appealing to sell out your positions when in reality, you should just hold the funds long term. But I will say my experience on Fidelity with the index-based mutual funds has always been really good, and it's convenient how you can place automatic transfers with any mutual fund you choose and can place however much you want and however often. Although you can't do that with ETFs on their platform, other platforms like SoFi allow you to do it with ETFs, and that is what I prefer to do with my taxable accounts. Now you may wonder, why does it even matter whether it's a taxable or non-taxable account? And that right there is the deal breaker for me on when to invest in ETFs or mutual funds and why I'm mentioning that in this video. I say this because when you invest into mutual funds, whether it is active or passively managed, whenever the actual investments, the companies that are inside of the fund are sold off, you are going to be triggered with capital gains or losses, even though you didn't sell the actual fund. If you didn't understand that, imagine that you had the S&P 500 index fund on Fidelity, which is FXAIX. And because this consists of 500 of the largest companies listed on US stock exchanges, let's say that after a full year, 5 of the companies were removed, say they reduced in size significantly, or they went bankrupt, and then 5 new companies were added. This scenario can be used as a metric called the turnover ratio, which measures the amount of times the securities that are inside of the fund are bought and sold within a year. But typically, passively managed funds are going to have a lower turnover ratio than actively managed ones because actively managed ones are going to be buying and selling stocks much more often. To better explain this, here's a quick visual to show you how the S&P 500 index fund has a turnover rate of 3%, where an actively managed small cap growth fund, for example, is 60%. 60% is extremely high of a turnover rate, and if you are in a taxable account using these mutual funds, that is going to trigger much more capital gains taxes than if you were to have an ETF. And I know we're getting deep, but I truly want you to understand why ETFs are a much better decision, especially for taxable accounts. And that's because, from the example, the 5 companies were sold. That means the capital gains and losses were triggered to your account even though you had the fund the entire time and never sold it. Investors who don't understand the structure of mutual funds may be in for a really hard time because all of a sudden they may see a huge tax bill at the end of the year because of that. And just so I can emphasize this even more to you, an article I found shows that even if you own the mutual fund, hold on to it, and it declines 20-30%, you could still be asked to pay capital gains taxes. This is because the gains would have come from managers buying and selling securities inside of the portfolio throughout the year, and if they sold a stock that had a massive gain, even if the stock or fund is down in the current year, you will be charged taxes on the overall gain. And that right there is the main reason toward why I decided to create this video, because if that was an ETF, you would not have been hit with any capital gains because you only trigger capital gains or losses when you sell the entire fund, the entire ETF. Thus, that gives you much more control over your taxes and is why I recommend ETFs in any taxable account. So that about covers the main differences between ETFs and mutual funds. Let me now show you the overall benefits of using ETFs. Now you could invest into actively managed ETFs, but I personally prefer index-based ETFs, and here's why. Index-based ETFs are extremely easy, saves you time, requires little financial knowledge, are much cheaper than active funds, historically proven to be better than picking individual stocks. ETFs also give you flexibility since you can buy and sell anytime you like, give you more control over your taxes, have no minimum required investment amount, and can be purchased on nearly any brokerage firm. And I will say, if you're still watching this, I'd really appreciate you hitting the like and subscribe button for future content like this. With that being said, let's now go over the best ETFs you should know about. So the first ETFs I'm going to mention are ones that track the S&P 500 index, which some of the best ones that you could choose from could be VOO, which is Vanguard's ETFs, as I showed earlier, with a 0.03% expense ratio and an annual return over the past 10 years being 12.6%. You could also look into SPY, which is the one I stated was from 1993, the first ETF, which is Spider's version that comes at a 0.0945% annual expense ratio and an average annual return of 12.52% over the past 10 years. Or if that doesn't interest you enough, you could also consider the iShares version IVV that has a 0.03% expense ratio and, surprisingly enough, a higher average annual return at 12.82% over the past 10 years. And the reason I'm mentioning the S&P 500 is because, based off of history, it is known to produce great returns for investors, and is why Warren Buffett quote-unquote states consistently buy an S&P 500 low-cost index fund where he thinks it is the thing that makes the most sense practically all of the time. The statistics people use everywhere for how great the S&P 500 is to invest into over the next 30-40 years is honestly annoying how much people emphasize it. But the results are crazy, so let me emphasize it even more. The S&P 500, if you had it sitting $10,000 in 1980, that would now be worth over $1 million from doing nothing. But moving on from there, if you wanted more exposure to the US market besides just 500 of the companies from the S&P 500, you could get a total US stock market ETF, and what I prefer is the Vanguard's version, that is VTI, that has a 0.03% expense ratio and an average annual return over the past 10 years of 12.08%. And moving on from there, if you want to gain exposure to companies outside of the US, you could consider getting a total international stock ETF like Vanguard's VXUS that has a 0.07% expense ratio and has averaged 5% annually over the past 10 years. Which, if you want more options, you could get iShares version, that is IXUS, at a 0.07% expense ratio and an average 10-year annual return of 5.04%. I also want to mention for dividend lovers that there are many different types that you can invest into, like the Vanguard's Dividend Appreciation ETF, ticker VIG, that yields 1.8%, or their High Dividend Yield ETF VYM that yields 3.3%. But I'm going to be completely honest with you right now, my go-to is the Schwab US Dividend Equity ETF, ticker symbol SCHD, that yields 3.5%. And for those that are shooting for the stars with the highest dividend earning kings, you could get the iShares Select Dividend ETF, ticker DVY, that yields 4.1%. And the last type I'll mention are bond ETFs, where you can actually invest into many different types of bonds all within one purchase, and you can buy and sell them whenever you want instead of having a fixed time period. A typical ETF that I use for this is the Vanguard Total Bond Market ETF, ticker BND, with an expense ratio of 0.03% and an average annual return of 1.47%. But don't let this turn you off, because if you're someone who temporarily wants to keep things safe, this fund currently yields 4.59% because of the current market conditions as of the recording of this video. Which I will mention, what you could do instead is have a money market fund as your core position, which is what I do on Fidelity, and basically any cash that is not invested earns you interest until you alter your positions. For more information on that, I highly recommend you check out my money market fund video for better understanding, which I'll have linked in the description below. Now I'm going to be straight up with you, I don't have many bond funds, and I'm going to cover exactly why later in this video when I discuss building a portfolio. So now that you know many options that you could use to get started today, and there's even more options out there if you decide to research more into it, let's now go over real world examples on how you can build a strong portfolio using ETFs. So first things first, this is just a general guide for you to learn as you get started, and it does not mean you have to do this. Now there are three main types to an investing approach that many people and even robo-advisors use, that is conservative, moderate, or aggressive with your investments. These positions all vary based off of your specific position in your life, but generally a conservative approach consists of 15% US stocks, 5% international stock, and 80% bonds. Now truthfully, I will probably never do this, but if you're someone that doesn't want to take on much risk, or maybe you're at retirement and you want to be safe and be assured with your account, then this portfolio, this conservative approach, may be the one for you. Then after that is a moderate approach, which typically consists of 33.3% US stock, and then equally among international stock and bonds as well. Or my favorite, which is the aggressive approach, and if you're doing this for 10, 15, 20 years plus, then based off of history, you could be assured that this is going to be pretty safe. At least for my position, I am happy to do so. This includes 65% US stock, 15% international, and 20% bonds. Now I'm even more aggressive with my investments because I don't have many bonds, but the fact is I'm young and I'm willing to take on risk because I'm in this for the long term and I'm not looking to sell anything in the near future. But I want you to see what each approach I'm about to show you would actually have achieved based off of history. And just so you know, when it comes to looking into the data, for me, I tend to prefer looking at companies or funds that have at least 10 years of data to view and see how their historical performances have achieved, even though it does not guarantee future results. So by using this nice website called Portfolio Visualizer, which I'll have linked in the description below, it comes out to be that a conservative approach with the Vanguard Total Stock Market VTI, Total International VXUS, and Bond Fund BND, that from January 2012 to May 2023, the portfolio would have achieved a CAGR, which is the compound annual growth rate, of 3.39%. I know you're all saying that's not great, but that's expected when you have 80% bonds. The next portfolio has the same time frame but shows a moderate approach that is equal toward each fund, except the US stock has 34% because the software couldn't do 33.33 for each. But this is where you'll start getting interested, as the portfolio over that period would have achieved a compound annual growth rate of 6.78%. Then lastly is the aggressive approach that includes much more US stock than international stocks and bonds, and from the study it would have achieved achieved a 9.55% compound annual growth rate. What's crazy is that this comes from only purchasing 3 ETFs, 3 funds that are super easy to buy and sell, and you can purchase them on nearly any platform. On top of that, you would have converted $10,000 into $28,321 without even adding more money to your portfolio during that time period. And that right there is what I call the easy 3-fund portfolio approach that I've created an entire video on recently, and even a free template that is a guide to 3-fund portfolios for you to learn more about, because this is a great way to gain massive exposure to the market while only purchasing 3 funds. So if you're a beginner, this is something super easy to do for you to learn as you get started and more involved with investing. Now, for those that are still watching, I have one more bonus for you, but first, if you did find value in this content, I would really appreciate it if you hit that like button and shared it with one person that you think could benefit from it. Now that that's done, here are some of my favorite ETFs that I personally own. The first is VOO, which is Vanguard's S&P 500 ETF. The second is VB, Vanguard's small cap ETF. VO, which is Vanguard's mid cap ETF. Then there's VTI, which is Vanguard's total stock market ETF, which overlaps the first 3, and VXUS, Vanguard International Stock ETF. Then number 6 is BND, Vanguard's Bond Fund ETF. Number 7 is VAW, Vanguard's Material ETF. VGT, Vanguard's Infotech ETF. 9 is VCR, Vanguard's Consumer Discretionary. And 10, SCHD, Schwab US Dividend Equity. Now I want to emphasize you need to be aware of certain funds before purchasing, because there's ones like VOO and VTI where 99.4% of VOO's holdings are in VTI and has an 86% overlap by weight. If you're interested to learn more about overlap and the top Vanguard ETFs that I recommend to buy for building long-term wealth, be alert for my next video, which once it is created and posted, I will have a pop-up here straight to it and a link in the description of this video for you to directly get to that video. Alright, so now that you know some of my favorite ETFs, let me know in the comment section below this video what yours are. I'm really interested to see and learn from you as well, because there are probably many options that I'm not even aware of. And if you're also interested in learning more about ETFs, I will leave relevant videos that I've created about ETFs in the description of this video, which while you're checking that out, you should also check out my free Money Talk Monday newsletter, because I aim to write once a week on financial topics I think could greatly benefit you. I really appreciate you all for watching. Don't forget to hit the like, subscribe, and notifications button to be alert for future Money Talk content like this.